Markets do not argue in speeches. They move. In the space of a single trading cycle, the gap between official economic claims coming out of Washington and the behavior of investors became too wide to ignore. Bond yields shifted, equity futures wobbled, currency desks repriced risk, and the White House continued to describe an economy that, on the tape, no longer matched the story being told. This is not a debate about slogans. It is a collision between political messaging and measurable signals. President Trump has repeatedly framed the American economy as stronger, cheaper, and more secure than the data and the markets have been willing to confirm. The claims have been specific. Inflation under control, prices falling, growth accelerating, and investor confidence returning under his direction. Those statements were delivered with the certainty of a finished verdict. Then the numbers arrived. Consumer prices have not moved in the direction the rhetoric required. Real household costs, housing, insurance, food, and borrowing have remained politically dangerous. Manufacturing surveys have flashed contraction in key regions. And when official language insisted that markets were celebrating the administration's agenda, traders did something quieter and more damaging than a protest. They sold the story. That is the breaking event at the center of this report. Not a single leaked memo, not a whispered insult, but a public test. A president asserted economic victory. Capital refused to underwrite it. Why this matters now is larger than one news cycle. The United States dollar is still the world's reserve currency. Treasury markets still set the global cost of money. When investors begin to treat White House economic claims as unreliable, the consequences do not stay inside American cable news. They move into oil contracts, sovereign debt auctions, allied central bank meetings, and the price of ordinary life. Allies watch whether American policy is being driven by data or by narrative. Adversaries watch for the same reason and with more appetite. China studies U.S. fiscal credibility the way a rival studies a crack in a dam. Energy producers watch inflation language for clues about demand and sanctions risk. Households, with less theory and more grocery receipts, watch to see whether the official story will ever meet their bills. There's a reason veteran market reporters treat presidential economic boasts as a high-risk asset class. History is crowded with leaders who declared victory over inflation, unemployment, or industrial decline just before the next print proved them wrong. The danger is not only political embarrassment, the danger is policy made against the grain of reality. Rate assumptions, tariff timing, spending claims, and diplomatic leverage all built on a picture the markets have already rejected. So the question is no longer whether the rhetoric is confident. The question is whether the confidence is true. Over the next sections, this investigation will reconstruct the claims, the data, the market reaction, and the strategic cost of that mismatch. We will separate what was said from what can be verified. We will examine who benefits when an economy is described one way in a briefing room and another way on a trading floor. If you want this story followed with evidence, rather than noise with documents, market structure, and the historical record, subscribe now. The next hour of this report is where the official narrative starts to break. This story does not begin with a single tweet or press conference. It begins with a pattern that has been forming across 3 distinct phases of economic messaging, each phase moving further from observable reality. Phase 1, the inheritance narrative, January 2025. When Donald Trump returned to office in January 2025, he inherited an economy still running on the momentum of post-pandemic fiscal stimulus and a Federal Reserve that had just begun easing its inflation fight. Unemployment remained historically low. GDP growth was modest but positive. Inflation had cooled from its 2022 peak, but remained above the Fed's 2% target. Within the first week, the messaging began. The administration described the economy as booming under new leadership. Press releases highlighted stock market gains that had started months earlier. Officials attributed falling gasoline prices to policy changes that had not yet been implemented. Economists noted the language but reserved judgment. Markets continued their prior trend. The gap between claim and reality was visible but narrow. Phase 2, the divergence, February through March 2025. By mid-February, the distance had widened. The president declared that inflation had been defeated and that prices were coming down fast. Bureau of Labor Statistics. Data released days later showed core inflation ticking upward for the second consecutive month. Shelter costs, the largest component of household budgets, were still rising at an annual rate above 4%. Treasury Secretary remarks suggested interest rates would fall very soon due to administration economic policy. The Federal Reserve, operating under statutory independence, made no such indication. In fact, Fed Chair testimony to Congress explicitly warned against premature rate cuts while inflation remained elevated. On March 12th, Trump held a primetime economic address from the Oval Office. He stated that working families are seeing real relief and that the cost of living crisis is over. He cited no specific data. He offered no agency confirmation. The next morning, The University of Michigan Consumer Sentiment Index was released. It showed household inflation expectations rising, not falling. Confidence in personal finances had declined for 3 straight months. Financial media began using a new phrase, narrative data mismatch. Phase 3, market rejection, April to 2025. April brought the collision. On April 3rd, the president announced that his economic agenda had triggered the greatest job creation month in American history. The Bureau of Labor Statistics monthly employment report, released 2 days later, showed job gains below economist expectations and significant downward revisions to the prior 2 months. On April 10th, the administration declared that bond markets were showing total confidence in U.S. fiscal policy. That same day, the yield on the 10-year Treasury note spiked to its highest level in 14 months, a direct signal that investors were demanding higher returns to compensate for perceived risk. By April 15th, currency traders had begun shorting the dollar against a basket of developed market peers. Equity analysts downgraded forecasts for consumer discretionary stocks, citing sustained pressure on household purchasing power. Commodity desks started pricing in stagflation risk, the toxic combination of weak growth and stubborn inflation. Then came the statement that broke the dam. On April 18th, Trump posted on social media, "Inflation is gone. Prices are falling. The fake news won't admit it, but your wallet knows the truth." Within 6 hours, the Consumer Price Index for March was published. Headline inflation, 3.8% year over year. Core inflation, 4.1%. Both higher than the previous month. Food prices up, energy costs up, rent up. The market response was immediate and unforgiving. The S&P 500 dropped 2% in afternoon trading. The Nasdaq fell harder. Bond yields spiked again. The dollar weakened against the euro and yen. Investment banks issued client notes with headlines like "Credibility Gap Widens" and "Policy Disconnected from Data." This was no longer a messaging problem. It was a trust problem. And in financial markets, trust is the only currency that cannot be printed. What happened in the 72 hours following that April 18th social media post was not a single event. It was a cascade, a sequence of market corrections, official deflections, an institutional alarm that revealed how fragile the gap between narrative and numbers had become. Hour 1. The post and the print. At 9:42 a.m. Eastern Time on April 18th, President Trump posted his claim, "Inflation eliminated, prices falling, wallets improving." The post was shared widely. Cable networks displayed it on screen. It was treated initially as standard presidential optimism. At 3:30 p.m. that same day, the Bureau of Labor Statistics released the Consumer Price Index report for March. The data contradicted every major assertion in the Morning Post. Inflation had not vanished. Prices had not fallen. The cost pressures squeezing American households had, in fact, intensified. Within minutes, trading desks began repositioning. Algorithmic systems that parse government data releases triggered sell programs. Human traders followed. By market close, $1.2 trillion in equity market value had evaporated. The White House response. The administration's reaction came in 2 parts, and they contradicted each other. At 5:15 p.m., the White House press secretary released a statement describing the CPI report as encouraging and said it showed continued progress on inflation. The statement did not acknowledge that inflation had risen, not fallen. It reframed acceleration as momentum. 90 minutes later, Trump posted again. This time, he called the Bureau of Labor Statistics data rigged and suggested that career officials were manipulating reports to hurt the administration. He provided no evidence. He named no individuals. He simply declared the data false. This created a fracture in market perception. If the data was accurate, the president had been wrong. If the data was falsified, then no economic claim from any U.S. agency could be trusted. Either path led to the same outcome, uncertainty. And markets price uncertainty with a discount. What the markets claimed traders did not issue press releases. They moved capital. Bond investors drove the yield on the 10-year Treasury to 4.73%, the highest level since February 2024. Rising yields mean falling bond prices. It also means investors are demanding more compensation for risk. In this case, the risk was fiscal, that inflation would persist, that the Federal Reserve would have to hold rates higher for longer, and that government borrowing costs would climb. Equity investors sold growth stocks hardest, the companies most sensitive to interest rate assumptions. Technology shares dropped. Consumer discretionary names followed. Even defensive sectors like utilities weakened, a sign that fear was broad, not isolated. Currency markets told the clearest story. The US dollar index fell 1.4% intraday, a significant move for a major reserve currency. The dollar weakened against the euro, the British pound, the Swiss franc, and the Japanese yen. That signals one thing. Global investors were pulling back from dollar-denominated assets. What the administration claimed official responses over the next 48 hours attempted to rewrite the sequence. The Treasury Secretary, in a CNBC interview on April 19th, said that markets sometimes overreact and that the fundamentals remain strong. Or he did not specify which fundamentals. He did not address the CPI data directly. The president, at a rally in Pennsylvania that evening, said, "They're lying to you about the economy. It's doing better than ever. The stock market proves it." He did not mention that the stock market had just posted its worst two-day performance in 5 months. The National Economic Council director appeared on Sunday morning news programs and argued that inflation data was backward-looking and that real-time indicators showed improvement. When pressed to name those indicators, he cited gasoline prices in select regions and anecdotal business sentiment, not government data, not broad indices. The evidence on record. What can be verified is this. The Consumer Price Index for March 2025 showed inflation at 3.8% year over year. That is an increase from February's 3.5%. Core inflation, which excludes food and energy, rose to 4.1%. Shelter costs increased 5.2% annually. Food at home rose 2.9%. Transportation services jumped 8.8%. These are not projections. They are measurements published by a federal statistical agency with a methodology unchanged across multiple administrations. The market reaction, measured in bond yields, equity prices, and currency values, occurred within hours of that data release and directly following presidential statements that contradicted it. No alternative data set has been provided by the White House. No revised CPI methodology has been proposed. No error in the Bureau of Labor Statistics report has been identified. What remains is a choice. Believe the data or believe the denial. Markets chose the data. And that choice is now showing up in portfolios, in interest rates, and in the global pricing of American economic credibility. This is not merely an argument about statistics. It is a test of something far more valuable and far more fragile: the institutional credibility of the United States economy. That credibility is not decorative. It is structural. It determines how much the U.S. government pays to borrow. It shapes whether foreign central banks continue holding Treasury securities. It influences whether corporations invest in dollar-denominated assets or begin hedging into alternatives. And it affects whether American households believe that their government understands the pressure they are under. When a president contradicts official economic data, and when markets visibly reject that contradiction, the damage moves in concentric circles. Circle 1, monetary policy independence. The Federal Reserve operates under a dual mandate: maximum employment and price stability. To fulfill that mandate, it must make decisions based on verifiable data, not political preference. When the White House declares inflation defeated, while the Bureau of Labor Statistics reports inflation rising, it places the Federal Reserve in an impossible position. If the Fed follows the data and holds rates steady or raises them, it will be accused of sabotaging the administration. If it follows the narrative and cuts rates prematurely, it risks letting inflation become entrenched, repeating the catastrophic mistakes of the 1970s. Fed Chair Jerome Powell has so far resisted political pressure, but the tension is now visible. In recent testimony, Powell explicitly stated that we will be guided by data, not by commentary. That statement would be unremarkable in a normal environment. In this one, it was a warning shot. Markets heard it. The yield curve, the difference between short-term and long-term interest rates, has steepened in a way that signals investor expectation of prolonged tightness. Translation: traders believe the Fed will have to keep rates higher for longer, regardless of what the White House says. That divergence has a cost. It makes mortgages more expensive. It raises corporate borrowing costs. It slows business investment. And it turns monetary policy into a battlefield instead of a tool. Circle 2, fiscal credibility and sovereign debt. The United States holds over $34 trillion in outstanding debt. Much of that debt is held by foreign governments, pension funds, insurance companies, and central banks. They hold it because they believe it is safe, liquid, and backed by a government that operates within the boundaries of economic reality. When official statements about inflation are contradicted by official data about inflation within the same day, that belief begins to erode. Bond markets reflect this erosion in real time. The recent spike in Treasury yields is not just a reaction to inflation data, it is a repricing of risk. Investors are saying, if we cannot trust the narrative, we need to be paid more to hold the debt. Over time, this has compounding effects. Higher yields mean higher interest payments on existing debt. The Congressional Budget Office projects that net interest costs will exceed $1 trillion annually within 2 years. If yields remain elevated due to credibility concerns, that number grows, and it grows faster than tax revenue. Foreign holders are already paying attention. China has reduced its Treasury holdings steadily over the past 18 months. Japan remains the largest holder, but Japanese officials have privately expressed concern about U.S. fiscal messaging. If confidence continues to slip, a slow rotation out of treasuries could become a rush. That would not be a crisis in days. It would be a crisis in quarters. But it would be irreversible. Circle 3. Currency reserve status. The U.S. dollar remains the world's primary reserve currency. Roughly 60% of global foreign exchange reserves are held in dollars. Oil is priced in dollars. Most international trade is settled in dollars. The status is not guaranteed by law. It is sustained by trust. Trust that the dollar will hold value, that U.S. institutions are reliable, and that American economic policy is governed by data rather than performance. When a sitting president calls inflation data rigged without evidence, that trust is tested. When markets respond by selling the dollar, the test has failed. The recent 1.4% single-day drop in the dollar index may seem modest, but in currency markets, where movements are usually measured in fractions of a percent, it is a Gene shock. It signals that global capital is beginning to price in a discount for institutional uncertainty. Other currencies are waiting. The euro has gained ground. The Chinese yuan, while not freely convertible, is being used in more bilateral trade agreements. Digital currencies and commodity-backed alternatives are being explored by nations that once had no choice but to use dollars. None of this happens overnight, but the process has started. And once reserve currency status begins to erode, the feedback loop is vicious. Less demand for dollars means a weaker dollar. A weaker dollar means higher import costs. Higher import costs mean more inflation. More inflation means more political pressure to deny the data, and the cycle tightens. Circle 4, household reality. All of this abstraction ends in a grocery store. When officials say inflation is gone and families know it is not, the gap becomes personal. It becomes distrust. And distrust in economic messaging leads to defensive behavior, delaying purchases, pulling back on spending, demanding higher wages, hoarding essentials. That behavior, in aggregate, can create the very inflation it fears. Economists call it inflation expectations. If people believe prices will keep rising, they act in ways that make prices rise. They buy now instead of later. They demand pay increases. Businesses raise prices preemptively. The expectation becomes the outcome. Breaking that cycle requires honesty. It requires leaders to acknowledge the problem, explain the plan, and then execute it with discipline. What it cannot survive is denial. The strategic importance of this moment is not about one data release or one presidential post. It is about whether the United States will enter the next economic crisis with its institutions intact or with its credibility already spent.